What if I told you that the loudest, most engagement-optimized voices in this entire space are unintentionally, or in some cases very intentionally, setting up the people who follow them for the worst psychological collapse of their investing lives, and that the cure is not bearish dismissal of the thesis, but something far more uncomfortable. Mature, disciplined, time-frame honest analysis that the algorithm has been trained to bury? Strong claim, I know. But before you scroll past this video, ask yourself this brutal question. How many times in the last 6 months have you seen a prediction promising XRP at $1,500 or $2,500 within months? Felt your heart rate quicken? Mentally calculated what your bag would be worth? And then, when the timeline failed to materialize, felt yourself slip closer to giving up on the asset entirely? That cycle is not random. That cycle is the predictable output of an attention economy that rewards extremity, escalates expectations, and then leaves the audience emotionally exhausted when reality refuses to comply with the compressed timeline the content promised. The result is that retail ends up exactly where the institutions need them to be, selling out of frustration at the worst possible moment in the cycle. While the crowd is being whipsawed between extreme predictions and extreme dismissals, something far more durable is being assembled behind the curtain. Today, I'm going to walk you through the gap between social media reality and macro reality, the actual pace of institutional integration, the demographic gravity nobody is weighting correctly, and what the realistic XRP path forward actually looks like when you do the analytical work instead of chasing the algorithm. And the world, once again, is missing the signal. But the signal is hidden underneath the noise the loudest voices in this space have engineered. Welcome back. On this channel, we don't trade hype, we decode structure. Today, we are going under the hood of one of the most psychologically destructive dynamics in the entire crypto information ecosystem: the systematic mismatch between compressed timeline predictions and the actual pace of institutional infrastructure adoption. No moonboy fantasies, no emotional charts, no cynical dismissals either. Just the documented adoption curves, the institutional behavior patterns, and the discipline that retail has been trained to ignore. Before we go under the surface, this is informational analysis, not financial advice. Let's jump in. Let's start with the hard truth. 99% of XRP holders are operating on a timeline that mathematically cannot accommodate the institutional integration sequence they are betting on. They want $1,500 within 12 months. They have read content promising it, they have internalized the urgency, and they have built emotional positions around the expectation that the entire global financial system is going to migrate onto blockchain rails before the next major holiday weekend. That expectation is structurally incompatible with how institutions actually behave. And the gap between expectation and reality is where retail conviction goes to die. Here is what you need to internalize before anything else in this video makes sense. The underlying thesis is correct. The timeline is wrong. Those are completely different things. And the difference between them is worth real money, but only to the people who can hold both truths at the same time. Here is what almost nobody on this platform is willing to say clearly. The internet did not become dominant in 12 months. Mobile phones did not transform commerce in a single year. Cloud computing did not replace on-premises infrastructure overnight. Artificial intelligence is not reshaping every industry in a single quarter. These are adoption curves measured in decades, not weeks. And the documented history of every previous infrastructure transition shows the same pattern. Markets overprice short-term adoption. then violently correct when reality fails to deliver on the compressed timeline, then underprice long-term transformation, then quietly compound for years while the headlines move on. The people who win are the people who survive both the overshoot and the undershoot. That is not a glamorous strategy. That is not engagement-optimized content. That is just how transformational technology actually rewards capital over time. Brad Garlinghouse has, in his own measured language, framed Ripple's institutional strategy around exactly this multi-year reality. David Schwartz has spoken at length about the methodical pace of regulated adoption. These executives are not communicating in $1,500 time frames because they understand the actual pace. This is not coincidence. This is convergence between leadership posture and structural reality. And once you see the convergence, you cannot unsee it. Let's do the math, the kind retail desperately wants to ignore. Two completely separate analytical frameworks operate simultaneously in the XRP market, and conflating them is the source of almost every emotional mistake in this space. Framework 1 is the speculative reflexivity framework. Under this framework, narrative drives price, liquidity rotations produce violent repricing, and assets can experience spectacular short-term rallies when catalyst events compress into a tight window. This framework is real. Under it, XRP can absolutely reach $5, $8, even $12 to $20 within a single catalyst-rich window. Clarity Act passage, a major ETF filing, a coordinated institutional announcement cycle. Those numbers are not fantasy. They are within the operating range of speculative reflexivity meeting genuine institutional catalysts. Framework 2 is the structural utility framework. Under this framework, price is a function of network throughput, settlement volume, institutional integration depth, and the constrained supply against the demand the asset is actually being used to absorb. This framework produces the long-term destination prices, the $100 scenarios, the $500 scenarios, even the multi-$1,000 scenarios that the monetary architecture models output. These are not lies. They are the mechanical results of plugging full institutional adoption assumptions into a fixed supply asset. The math at those inputs produces those outputs. But, and this is the critical analytical honesty, the inputs required to satisfy those outputs are decade-scale conditions. They require XRP to evolve from a payment infrastructure asset into a settlement-grade asset embedded operationally in global finance. That evolution, if it occurs, is the destination of a multi-year adoption sequence, not its starting point. Now layer the supply mechanics. XRP has a hard cap of 100 billion tokens. Roughly 40 billion remain in escrow under transparent on-chain release rules. 5 to 7 billion are estimated permanently lost. Approximately 800 million XRP are now locked in ETF custodial structures. SBI Holdings has issued instruments redeemable in XRP. Evernorth Holdings holds hundreds of millions of XRP as treasury reserves. Strategic reserves, partner allocations, market maker inventory, and long-term institutional holders absorb tens of billions more. The actual freely tradable float is far, far smaller than the headline number suggests. And the freely tradable float continues to compress, regardless of which timeline framework you operate under. Supply contraction is not a hypothesis. It is an observed on-chain pattern. Now layer the demand picture. The global cross-border payments market processes roughly $150 trillion every single year. The foreign exchange market alone moves $7.5 trillion every single day. The Bank for International Settlements documents approximately $27 trillion sitting idle in Nostro and Vostro accounts. The derivatives market sits at an estimated $1.2 quadrillion in notional value, the global real-world asset tokenization opportunity. Equities, bonds, real estate, commodities, treasury products, invoices, programmable ownership structures represents potentially hundreds of trillions of dollars of assets that may eventually migrate to blockchain rails over the coming decade. If even 0.5% of that total opportunity flows through the rails most aligned with institutional settlement, the demand pressure against the constrained float is enormous. This isn't a prediction. It is the design specification of any settlement asset that absorbs trillions in tokenized flow. If you have a problem with these numbers, you don't have a problem with me. You have a problem with the math of global financial modernization. Now let me address the part of this conversation that almost every other channel skips, the demographic dimension. Grayscale's recent data shows that approximately 45% of Gen Z and millennial investors already own crypto, compared to roughly 18% of older generations. That gap is not a statistical curiosity. It is the leading indicator of where the next several decades of capital allocation will go. Over the coming 2 decades, an estimated $68 trillion in generational wealth is set to transfer from older holders to younger heirs. The destination of that transfer will follow the trust patterns and asset preferences of the inheriting generations. And those generations have quantifiably, dramatically more comfort with on-chain, transparent, programmable financial systems than any prior generation. That is not hype. That is documented demographic data. And demographic gravity, layered onto a multi-decade institutional integration arc, is the structural tailwind that makes the long-term thesis credible. But the timeline is decades, not quarters. Here is the discipline retail keeps failing to apply. The existence of a long-term bullish tailwind does not guarantee explosive short-term outcomes. A decade-scale demographic shift does not produce a quarter-scale vertical price move. Both can be true simultaneously. The long-term destination is structurally enormous, and the short-term path is moderate, choppy, and frequently boring. Holding those two truths together is what separates the people who win the cycle from the people who emotionally exit at exactly the wrong moment. While retail is panic buying tops and panic selling bottoms, the institutional signal has never been louder. Look at what is actually happening, not what is being broadcast on social media. The Depository Trust and Clearing Corporation, the DTC, which sits at the core of global financial settlement infrastructure, is actively piloting tokenized settlement mechanisms. The New York Stock Exchange is exploring blockchain infrastructure. Nasdaq is publicly discussing digital asset frameworks. Securitize, BlackRock, Franklin Templeton, Fidelity, JP Morgan, every apex institution in traditional finance is publicly building blockchain settlement infrastructure. The Bank of England has openly discussed digital cash interoperability. The Bank of Japan publishes CBDC research that explicitly discusses interoperability layers on a near-monthly cadence. The European Central Bank publishes interoperability research at the same frequency. The IMF has openly discussed the need for a more efficient cross-border architecture in multiple working papers. These institutions are not validating crypto because of social media enthusiasm. They are validating it because reducing settlement costs and increasing liquidity efficiency represents tens of billions of dollars in savings across the global financial system. The economic incentive is structural, not narrative. Ripple has spent the last several years deploying over $3 billion in strategic acquisitions, specifically to build the institutional bridge that absorbs this exact opportunity. Metaco for bank-grade custody, Standard Custody for New York regulated trust services, Hidden Road as a prime brokerage clearing trillions annually, Rail for stablecoin-powered payments, G Treasury for Fortune 500 corporate treasury management, Palisade for advanced wallet and custody technology. This is not a startup hoping for adoption. This is the steel and cement of the new financial system being assembled at the deliberate pace required for sustainable, durable, regulatory compliant integration. Ask yourself this brutal question. Does a firm with the legal exposure of Ripple, after years of litigation against the SEC, deploy over $3 billion in traditional finance acquisitions if the long-term institutional adoption sequence were not real? Absolutely not. They don't gamble. They position. And the people who really matter, the silent actors, are positioning right alongside them on a timeline that matches institutional reality, not retail emotional urgency. So when does the speculative reflexivity collide with the visible market? Pay attention here, because the near-term catalysts are no longer theoretical. They are scheduled. The Clarity Act and broader market structure legislation moving through the United States Congress represent the immediate regulatory catalyst. The Senate Banking Committee markup is on the calendar. The legislative path from markup to floor vote to House reconciliation to presidential signature projects on the realistic timeline into the early summer window. If the bill is signed in that window, Standard Chartered's published research projects $4 to $8 billion in additional XRP ETF inflows by year-end. Stephen McClurg of Canary Capital has documented that combined XRP ETF assets reaching approximately $3 billion is the threshold at which BlackRock's internal product committee is empowered to proceed with its own filing. The Standard Chartered passage projection crosses that threshold by a factor of 2 to 3. None of these are vague claims. They are documented, named, and quantified. In Asia, Japan's Financial Services Agency has already moved decisively to recognize XRP as a regulated digital asset. The Bank of Japan continues to publish CBDC research that explicitly discusses interoperability layers. The European Union's MiCA regulation is now fully operational, providing the legal certainty European banks have been demanding for years. The largest bank in Italy has integrated Ripple custody into its broader digital asset strategy. Each of these developments is another wall coming down between institutional capital and on-chain settlement. But at institutional pace, not retail pace. Then there is the macro layer. The Federal Reserve continues to evolve its posture. A Fed chair transition is approaching that, by every credible candidate's documented record, points toward a more accommodative stance on payment system modernization. Global debt levels are forcing every major central bank to consider new settlement architectures. The IMF has openly discussed the need for a more efficient cross-border framework. Layer on top of that, the rise of AI agents requiring instant programmatic settlement. The fuse is already lit. There are multiple fuses. They are lit in parallel, but they burn at different rates. Disciplined positioning understands that. Now let me address stablecoins specifically, because retail vastly underestimates their structural importance. Stablecoins sound boring compared to speculative altcoins, and that is exactly why most retail underweights them. But stablecoins are quietly becoming the bridge between traditional finance and blockchain ecosystems. Faster settlement, global accessibility, programmable money, reduced transaction friction. These are not minor improvements, they are operational unlocks. And if stablecoin adoption scales into the billions of users over the next decade, which the current trajectory suggests is plausible, the entire blockchain infrastructure layer becomes exponentially more valuable. The assets tied to liquidity movement within that environment thrive structurally, not speculatively. Now let me give you the realistic XRP path forward, because this is where disciplined expectations actually matter. Before XRP reaches hundreds of dollars, it must first reclaim prior highs consistently. That is reality. Markets move in stages. You do not go from current prices to $1,000 valuations without traversing every meaningful liquidity zone along the way. $3 matters, $5 matters, $8, the standard chartered passage target, matters. $12 under aggressive ETF flow assumptions matters. $28, the standard chartered extended target, matters. Each of those levels is a psychological and structural milestone that represents increasing confidence from market participants. And if XRP eventually enters a phase of true institutional utility expansion, those levels are realistic over time. But expecting immediate vertical repricing to $1,500 ignores how market structure has ever evolved in the documented history of finance. One of the healthiest things you can do as an investor right now is separate long-term conviction from short-term fantasy. You can believe XRP has enormous future potential, while still acknowledging that institutional adoption takes time. That mindset is the single most important psychological defense against the emotional whipsaw that destroys most retail positions. When unrealistic expectations meet reality, frustration sets in, then capitulation near cycle bottoms, then disbelief during the early recovery, then the cycle repeats. Understanding the actual macro adoption curve helps investors remain emotionally stable through volatility. Now let's talk about the side of the equation most people refuse to confront. Supply drain. While the demand side is being assembled at institutional pace, the supply side is being quietly removed from the open market. Exchange reserves of XRP have been trending lower for an extended period. CryptoQuant data, Glassnode analytics, on-chain forensic researchers, every credible source confirms the same trend. Tokens are leaving exchanges and entering custody. Once a token enters a multi-signature institutional vault or an ETF custodian's reserves, it does not come back to market for a 10% profit. It is gone. It is parked. It is reserved for the new system. We are moving from an era of abundance to an era of scarcity. And retail has not priced this in. Not because the scarcity is happening too fast, but because it is happening at exactly the institutional pace retail's emotional timeline cannot tolerate. The XRP rich list shows wallets in the shark tier, those holding between 100,000 and 1 million XRP, growing in number through every recent down cycle. Long-term holding wallets sit at all-time highs. The supply transfer from impatient hands into patient institutional custody is a documented structural reality. New buyers eventually will not be buying whole XRP. They will be buying drops. 1 XRP equals 1 million drops. Over time, drops will be the dominant unit retail accumulates in. There is a phrase you will start hearing more often: the great priced out. It refers to the moment when retail realizes the entry price they wanted no longer exists. That moment is not the next quarter, but it is somewhere on the multi-year institutional adoption arc, and the window is closing inexorably. I know exactly what you're feeling right now. You're watching red candles, you're seeing predictions that promise moonshots in months and dismissals that promise nothing forever. You're seeing influencers pivot to whatever shiny narrative is trending this week, and the temptation to either chase the extreme prediction or capitulate to the extreme dismissal has never been louder. I understand that. but my job is to help you distinguish between noise and signal. The $1,500 near-term predictions are noise designed for engagement. The XRP is dead. Dismissals are noise designed for the same algorithm. The signal is the documented multi-year adoption curve, the institutional acquisitions that have already deployed $3 billion, the regulatory pathway that is actually scheduled, the demographic gravity that is actually documented, and the supply structure that is actually contracting on-chain. None of that stopped because the timeline is longer than retail wants. It accelerated. Being early feels exactly like being wrong, right up until the moment reality catches up. That is the cruelest psychological trap in this entire industry, and the institutions know it. They are counting on it. They need a steady stream of exit liquidity from the impatient to fund the entry of the patient. Markets reward anticipation over the correct time frame, not anticipation compressed into emotional urgency. The dot-com era is the perfect historical mirror. The internet thesis was correct. The companies that survived that correction and held their fundamentals went on to become some of the largest in the world. But the people who priced 10 years of adoption into a single year were destroyed. The people who panicked at extreme prices, sold at extreme bottoms, and declared the thesis dead missed the entire transformation that ultimately vindicated their original instincts on a timeline their psychology could not handle. XRP is structurally in a similar position. The thesis is correct. The timeline is longer than the loudest voices on social media want it to be. The disciplined holders who internalize that distinction position differently than the emotional traders who do not. If we extend the time horizon to 2030, instead of obsessing over the next 7 months, the conversation becomes far more interesting. By 2030, global stablecoin usage could realistically reach billions of users. Tokenized securities markets may be deeply integrated into financial infrastructure. Cross-border blockchain settlement could be normalized. Digital asset custody may be standard across major institutions. In that environment, XRP becoming substantially more valuable is entirely plausible. Not guaranteed, but plausible. That is the mature distinction. The most rational XRP thesis is based on gradual financial integration, utility scaling, liquidity expansion, and network effects compounding over time. One side compresses 10 years of adoption into 7 months. The other side dismisses 10 years of compounding tailwinds entirely. Neither side is doing the analytical work. The work is calibrating expectations to actual institutional pace, recognizing the documented catalysts, respecting the supply mechanics, weighting the demographic gravity correctly, and positioning with conviction for the long arc, while remaining mentally prepared for the short-term volatility that always accompanies emerging infrastructure adoption. The question is, are you watching the predictions or are you watching the adoption curve? History does not reward comfort. It rewards those who pay attention when the room is quiet, and those who can stay seated when the room is loud. Right now, the room is alternating between very loud predictions and very quiet structural building. The disciplined holders ignore the volume and watch the foundation. If you made it to the end of this analysis, drop the word patience in the comments. I want to see who actually understood what was decoded today. If you value this kind of deep structural breakdown, subscribe and turn on notifications because the catalysts are accelerating, but on the realistic timeline, not the social media timeline. The math doesn't lie, the structure is real, and the system is being built. Stay patient, stay rational, and as we always do, we don't wait for the future, we plan for it. This content is for informational and educational purposes only and is not financial advice. Always do your own research before making any investment decision.